So guys, dividend investing, at least in my opinion, is hands down the easiest way to create passive income. And over the years, this style of investing has been gaining in popularity with a lot more people taking an interest, which is so awesome. I love seeing this community continue to grow, and I love the fact that more and more people are actively working toward building a better future for themselves. But with that growth does come a lot of misunderstandings about dividend investing. So today, I want to clear up 5 of the biggest misconceptions that I see all the time. Before we get to that though, guys, I want to hear from you. Leave me a comment below and let me know what are some of the biggest myths or outright lies that you have heard about dividend investing. There's a lot of misinformation out there, and I would be curious to know about some of the things you've heard. Anyway, guys, one of the most mistaken ideas about dividend investing that I see all the time is the idea that dividend investing is boring. A lot of people think that it is just this slow way to invest and that watching paint dry would be more interesting. And I will admit, dividend investing can be a little bit slow, especially when you first get started and you're not bringing in a lot of dividends. I can imagine how some people would find that to be uninteresting, but that's not a bad thing. In fact, I think it could be a good thing. Dividend investing isn't something that typically involves making fast trades in and out of stocks or seeing high-flying returns overnight. Like, this is definitely no Wolf of Wall Street, and building long-term wealth shouldn't be that way. You shouldn't treat it like a casino, and you shouldn't have those expectations. And even though it's slow and steady, getting passive income and seeing that passive income grow every week is extremely rewarding, and speaking personally is one of the greatest thrills that I've experienced as an investor. Just seeing what my portfolio has been able to do over these last few years has been incredibly exciting, and the thing is, it's just going to get even more exciting the longer I do it. With that in mind though, it's important to remember that dividend investing is a long-term game, and it's definitely not a get-rich-quick way to invest, which I think is why a lot of people do find it to be boring. Just like anything else though, if you want to do it right, and if you want to build something lasting and worthwhile, it's going to take some time. But anyway, now moving on to this second misconception. I see this one all the time as well, especially when I'm talking about stocks like Visa or Rollins or anything else that has like a 1 to 2% dividend yield. So many people out there think that a low starting yield is bad. Like, if it's not high yield, they're not interested. And I'll admit a 1% dividend yield on its own isn't all that exciting, but that's just one piece of a much larger puzzle. There are a plethora of other things that you need to consider to determine whether or not a stock is a good investment. For example, what do the company's financials look like? You know, if the growth metrics look something like this, would you still consider it to be a bad investment? And then there's the matter of dividend growth. You know, if the company's dividend is only increasing at a low or mid-single digit rate, I can understand why you may not be that interested in it, especially if your goal is to eventually live off your dividend income, because those are kind of weak dividend stats. But what if the dividend growth CAGR was much higher, like 17% per year, which is what we're seeing here with Rollins? Would the 1% starting yield be a deal breaker for you then? I mean, with that level of dividend growth, your yield on cost would increase substantial over time. And after 5 years, you know, that 1% or so starting yield would grow to be about 2.2%. So that's a step in the right direction. And then after another 5 years, so after 10 total years under your belt, your yield on cost would grow to about 4.8%. Now I think we're getting into high yield territory after about a decade. And then if you just held on to this stock for another 10 years, so after 20 total years, your yield on cost goes from around 1% to over 23%, which is insane. And the point is, the longer that you hold these low starting yield, high dividend growth stocks, the better your cash flow return becomes. And that's just one side of the equation. When you consider that the share price tends to follow the trajectory of a company's earnings and its free cash flow over a long period of time, then a company with aggressively growing financials and also substantial dividend growth, like what we saw with Rollins there, that should result in substantial share price appreciation over the long run as well. So basically what I'm trying to reiterate here, guys, is that you can't judge a stock solely based on its starting dividend yield. There are so many other things that go into whether or not the stock could be a good investment over a long period of time. And I think you need to take all of those things into consideration. But anyway, now moving on to this third misconception, another belief that a lot of people have, especially those who are not dividend investors, which is understandable, is the idea that dividends are pointless unless you have a lot of money. These people think that unless you have like a $1 million portfolio or $2 million portfolio, then you're wasting your time trying to invest in dividend stocks, because otherwise the amount that you'll be generating from dividends with a lower portfolio value is pretty meaningless. And in all honesty, I do kind of see where they're coming from, because you do need a lot of money invested to reach a point where you can actually live off of your dividend income, and that takes a long time. But that's also true regardless of dividends. For you to be able to retire, even if you were going to be implementing something like the 4% rule, which many people think these days is antiquated, but either way, you're still going to need a lot of money invested before you can be financially free and live off your investments. As it pertains to dividends, though, I would hardly call them pointless, even if you don't have a multi-million-dollar portfolio. I think that's a huge over-exaggeration. I mean, speaking personally, if we look at my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to download this spreadsheet in the description of the video. But here we can see that I'm coming up almost on $100,000 in my portfolio. We're inching closer and closer, guys, almost there. And I'm at a point where I'm bringing in just about $265 per month in dividends on average. And it's only taken me about 5 years to get to this point, which in terms of investing is not a long period of time at all. Now, while this clearly isn't enough to pay all of my bills, I'm certainly not going to retire off of this $265 per month. It would be able to pay some of my bills if I wanted it to. And just seeing how this income continues to grow motivates me to continue pressing on, knowing that this portfolio is just going to be growing faster and faster over time. And also, eventually it's going to reach a point where my dividend income is able to cover all of my bills. And that aside, there are also psychological benefits to investing in dividend stocks as well. Like, for example, because dividend investing is a buy and hold strategy by nature, it can significantly reduce the stress that comes with constantly checking the market and making frequent trades in and out of stocks. When you adopt this buy and hold strategy, you're focused on the long-term health and stability of the companies in your portfolio rather than the short-term share price gyrations that will happen along the way. And because of that, whenever market downturns do occur, which you're bound to experience probably multiple ones in a long investing journey, but whenever these market downturns do occur, instead of freaking out about it, it's actually something that you can be excited about, because now you can buy these great cash flowing assets at a lower share price. And because the share price has gone down, you're also able to buy them with a higher starting yield. So there's a silver lining there. But anyway, guys, the next thing that I hear all the time is that you can't beat the market if you're a dividend investor. And that's just not true. I think this actually might be the biggest misconception out of all of them. And you know what, guys? I get snarky comments on my videos all the time from people saying things like, oh, have fun underperforming the market for the rest of your life. But since I started documenting my investing journey here on YouTube, my portfolio has actually outperformed the market by quite a bit. Here are my annualized returns going all the way back to October 2020. And as we can see, my dividend portfolio has the edge by a couple percentage points every single year. Now that might change over time, but so far we are off to a great start. And if nothing else, that just goes to show that, yeah, it is possible to see solid total returns if you invest in dividend stocks, so much so that you can possibly even outperform the market. And on an individual stock level, there are no shortage of dividend payers out there that have historically delivered better total returns than the market as a whole, like Lowe's, Rollins, which I mentioned earlier, Snap-on, Williams-Sonoma, which has been the top performer in my portfolio, and also Watsco, which is another great under-the-radar company. And this is just to name a few. And I know, guys, past performance doesn't guarantee future returns, but still, if it happened before, it's possible that it could continue happening. All right, guys, now moving on to this fifth misconception. This one is talking about dividend cuts, which are probably the worst thing that can happen to you as a dividend investor. And a lot of people feel blindsided by dividend cuts whenever they happen, or maybe they just turn a blind eye to the warning signs. But the reality is there are typically always warning signs there. You know, a company doesn't just wake up one day and decide to cut its dividend. Some of the red flags to watch out for include things like the payout ratio being too high, especially if you see the payout ratio over 100%, which means that the company is paying out more than they're bringing in. That's a pretty big red flag. But also you can look at the earnings and free cash flow trajectories. I mean, if those are going down and the dividend is staying the same or even continuing to grow, that's going to put a lot of pressure on the dividend and it will make it more difficult for the company to sustain. And if you do see these couple of red flags and you also notice that the company is taking on more debt, there's a chance that they could be borrowing money just to keep the dividend going, which is also a huge red flag. Overall, if a company is clearly stretching to maintain its dividend, then usually it's only a matter of time before they have no other option than to cut the dividend. And in this next video right over here, I'm telling you about 3 stocks that are showing some of these warning signs that we just mentioned. I think dividend cuts could be on the table for these 3 stocks. So click right over here to learn about those, and I'll see you in the next one.